Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome to the Retiring Canada podcast. In today's episode, we're going to discuss two crucial factors you need to understand when considering the use of joint ownership as an estate planning strategy. Specifically, we're going to discuss the pitfalls of probate planning, the two distinct forms of joint ownership, how a well-considered estate plan can protect your true intent, an example of what not to do, and lastly, as always, a few action items for you to consider. Let's get into it. Now, throughout my years as a wealth manager, I have come across this specific scenario a number of times, and chances are, if you or your parents own property, these exact questions may come up. Maybe you've been thinking about helping your aging parents' finances and are considering adding yourself to the title of their home or other property to make things quote-unquote easier. Or maybe you've been thinking about adding an adult child to that cabin property you want to ensure stays in the family. Well, I'm here to tell you that you may want to think again. It seems like a simple enough fix to help streamline your estate plan or that of your aging parent. Heck, it might even help to minimize the impact of probate fees. Now, what are probate fees, you may ask? Well, in Saskatchewan, when one passes, some assets may need to flow through the estate. The assets that do are subject to a probate fee of $7 per $1,000 of value passing through the estate. So say you or your last aging parent passes away and they have $1 million in property and land that has to flow through their estate. In Saskatchewan, this would trigger $7,000 in probate fees. Now, probate fees vary from province to province, so be sure to check out your relevant jurisdiction. This is often the starting point for many who think it may be best to avoid probate by adding themselves as joint owners on land or property. However, there are two distinct forms of joint ownership you need to understand before considering this strategy. Well, why may you ask? Well, because adding an adult child as a joint owner to property could have unintended tax and legal consequences that could significantly outweigh the perceived benefit of avoiding probate. So, if you're a Canadian living outside of Quebec and are considering sharing ownership of an asset with a child or aging parent during your lifetime, be careful. You'll need to specify which type of joint ownership you're choosing, but also be very clear about when both legal and beneficial ownership will be received. Again, if you're not careful, unintended tax burdens, estate complications, and family conflicts can result. All right, so let's break down these two forms of joint ownership a bit further and provide you a real-life example. The first form of joint ownership trust is the presumption of a resulting trust. This is the default ruling. In 2007, the Supreme Court of Canada ruled that when a parent graciously adds a child, adult child, as a joint tenant to an asset, the court presumes the child is holding the property in trust for the parent's estate. The child in turn does not receive beneficial interest of the property when he or she is added, only legal interest. In this case, there's no change in beneficial ownership when the parent adds the adult child, so no capital gains or losses are realized. During the parent's lifetime, the parent must report all future income and capital gains from the property. During the parent's lifetime, the child will not have any rights to any part of that asset. Now, when the parent dies, assuming they died first, the parent will realize all the accrued gains on his or her tax return in the year of death. The assets will be considered part of the deceased parent's estate. The child should transfer the assets to the parent's executor to be distributed in accordance to the parent's will, i.e., the child will not necessarily be the only one who will enjoy the asset. And lastly, if the deceased parent's executor is required to apply for probate, and the application for probate requires full disclosure of all estate assets, then the executor should include the value of the jointly held asset. This means that probate fees may be payable in respect of that asset. The second distinct form of joint ownership trust is rebuting the presumption of a resulting trust. And here there is strong evidence needed. The presumption of a resulting trust can be rebuted with evidence of the parent's intent to gift an interest to the child. Proving the property is a gift requires strong evidence in order to be held up in court, often requiring proper legal documentation of the intent of the transferor. So if evidence of a gift is produced, in this case, there is a change of beneficial ownership when the parent adds the adult child, potentially resulting in a partial disposition of the asset. If there is unrealized capital gains accrued, part of the gain would have to be reported at the time the joint owner is added, potentially resulting in a tax liability for the parent. During the parent's lifetime, the parent and children should report equal share in the future income and capital gains on that asset. During the parent's lifetime, the child will be part owner of the asset, meaning that the child's interest could be exposed to claims made by the adult child's creditors. This also includes child's spouses in the event of a divorce. Now, if the parent dies first, the parent will realize the accrued capital gains with respect to his or her remaining share of the asset on his or her tax return in the year of death. The asset will not be considered a part of the deceased parent's estate. The child will inherit by right of survivorship, free and clear of any claims made by other estate beneficiaries, and probate fees will not apply to the asset. Okay, a lot of legal jargon to take in there. Let's discuss a real-world example of how disruptive joint ownership can be if not planned for and discussed clearly with all family members. So here's an example. Let's take Susan. Susan was a 72-year-old widow with 3 adult children. 2 of her kids, Curtis and Grant, lived in other cities. Her daughter, Cindy, lived nearby and was actively helping care for Susan. One of Susan's best friends passed away. Susan heard that before her friend passed away, her friend listed her son as a joint owner of her home so that the son could inherit the house immediately and without probate fees. Susan thought this was a great idea, so she put Cindy as a joint owner of her home. Cindy was married with 2 children and did not live with her mother. Cindy owned a very successful business and struggled to try to balance all of her priorities: children, career, marriage, etc. Cindy's marriage started to have problems a few years later. Cindy and her husband finally came to a point where they decided to separate and get a divorce. The relationship became so tense that her husband decided to include Susan's home as a part of Cindy's assets and demanded a share. Soon after, Susan started to get ill. Curtis and Grant started to blame Cindy for their mother's illness, blaming the illness on the stress of her home being attacked by Cindy's ex-husband. Susan got so ill that she had to be moved into a nursing home. In order to pay for the nursing home with the comforts that Susan wanted, Cindy needed to sell Susan's home. When Cindy's ex-husband heard of the plan to sell the house, his lawyer put a caveat on the house to protect his claim. Now, if the house is sold, half of the proceeds from the sale of the house cannot be released to Susan. As a result, Susan and her children decided not to sell the house until Cindy's divorce was settled. However, this forced Curtis and Grant to start paying for their mother's nursing home, and this created even more tension between the siblings. Problems got even worse when Susan died. Susan's will said that all her assets would get divided and shared equally between her 3 children. Other than the house, which was worth $400,000, Susan had less than $100,000 in financial assets when she died. When Susan died, Cindy automatically became the sole owner of the house because she was the joint owner of the house. Her ex-husband has an even bigger target to attack now, even if he is ultimately unsuccessful. From the point of view of Curtis and Grant, they each receive $30,000 after tax from their mother's estate, whereas their sister now has a $400,000 house and $30,000. Curtis and Grant are obviously very upset because they do not see this as being an equal division of the assets as stated in their mother's will. In this case, Curtis and Grant could consider challenging the estate division, citing that the addition of joint ownership was the presumption of a resulting trust, and that there may not be sufficient evidence to be refuted. Okay, so at the end of the day, you want to be sure you're asking yourself the right questions and reflecting back on your will to ensure that the estate will be settled in line with your wishes or the wishes of your parents. This is where a properly structured estate plan, with the help of your financial professionals and legal counsel, can help to avoid these types of issues. Here are some questions to ask yourself so that you can reflect on your current estate planning documents. Which end result do you want to apply? A resulting trust or true joint tenancy? If you hold an asset in joint ownership with an adult child, what end result do you want? Do you want that child to have the share of the asset with other beneficiaries in your will, like other children, relatives, friends, or favorite charities? Or do you want your child to inherit the asset free and clear upon your death, with no obligation to share with the other beneficiaries of your estate? In the absence of a clearly worded contract or trust agreement between you, your aging parent, or adult child, the result may well be that your child and your other estate beneficiaries will spend all their time and money fighting about your intentions, and very few of the assets will remain to be enjoyed. Consider going to a lawyer to write a contract and update your will so they clearly explain your intention and expectations, and have your children agree with them. This contract will hopefully prevent possible fights after your death or your parents' death and ensure final wishes are addressed properly. All right, so your action items from today's episode. First, dust off your will and give it a read. Are your wishes still being met? Should you discuss your intentions with your family so that everyone's on the same page? Second action item is to meet with your certified financial planner to discuss how the structure of your will and beneficiary designations will impact your estate tax, estate equalization, family dynamics, and more. Oftentimes, these conversations can